Okay. My forte was
So this is the balance sheet, you recall, so, and it's the assets that are important here. And the fair market value of the assets is important. And the fair market value of bad assets is really important. Let's say that this company, instead of having an apartment building in it, had $2 million of cash. And it turns out, I mean, every business needs a bit of cash to operate, but it turns out in this case that $2 million is really a lot more than the company would have needed to operate. So part of that cash, probably something like $1.9 million of it is a bad asset. And let's say that the fair market value of the assets in total is $5 million. I just picked up a number out of my head. Fair market value, $5 million. Let's say that all of these are good assets, and I got 1.9 million bad asset. Okay. Cash accumulates over time. Cash doesn't just, get there. I mean, it gets there at the beginning because the shareholder put in $10,000 to begin with, but all of this cash happened over time because the company earned money and retained earnings and so on and so on. So it would have been smart if the shareholder thinking, someday I might like to claim this capital gain deduction, it might have been smart to take cash out every once in a while, even if the shareholder has to pay tax on it, to reduce, for example, the excess cash and maybe investments that this company has. Maybe the company's not actually holding $2 million of cash because they said, well, I'm not earning any interest on the cash. I'll buy some stocks and bonds, whatever. So maybe it would have been better if that money had been sort of flushed out over time. We call that purifying it, keeping the company pure so that the company can qualify on a moment's notice for the capital gain deduction in case somebody wants to sell the shares or somebody makes an offer to buy the shares. So we say it's a good thing to keep the company pure, that is able to pass the 90% test. And, well, it's sort of too late now. If the shareholder took a $2 million dividend or $1.9 million dividend, that would probably be a bad thing. Then you might say, well, okay, let's put in a holding company. But that doesn't really help us, and I'll show you why not. Here's the shareholder, and here's the opco. And it's got 1.9 of bad assets. Excess cash in this case. Well, we'll just set up a holding company, use Section 85 election, and we'll pay a dividend from here to here. The problem is that it's this company that's for sale. And if somebody were selling this company, it would have to be this company because this individual no longer owns it. The target company, OpCo, is owned by the HoldCo. HoldCos can't claim the capital gain deduction. Only an individual can. So it would have been better over time to pay some small amounts of dividends, $100,000 here, $200,000 there, and maybe the shareholder needs some money anyway to pay for stuff like household expenses and so on, to keep the company pure, because at some point it might just be too late on the day before a sale. Now when we talk about trust, we'll talk about some ways perhaps to purify a company on the day before. But in the meantime, we should at least be mindful, and you as lawyers be mindful and tell your client to be mindful that, hey, someday you might like to claim this capital gain deduction. Make sure you don't have too many bad assets, i.e. more than 10% of the value of the fair market value of assets. So keep the company pure if we can. When a company is pure, we might want to use the capital gain deduction, and we can, even if the company is not being sold tomorrow. And here's how we would do that. I own this OPCO. It qualifies today. It's what we would call a QSBC corporation, qualifying small business corporation, as described in the textbook and in 110.6. And there's like $2 million worth of appreciation in the shares. I paid $10,000 for the shares, and today they're worth $2 million. And I'm thinking, it would sure be good if I could use this 866. That would be awesome, because if they change the rules, for example, to delete the capital gain exemption, or if my company is no longer pure going forward, that is if the bad assets are more than 10% of the fair market value, then on the day I might want to sell this thing 5 years from now, I wouldn't be able to claim the capital gain deduction. But I can use it today. My adjusted cost base is, say, $10,000. I will transfer by Section 85 my shares to a holding company, and instead of electing at $10,000, I can elect at $866,000 plus $10,000. So I will elect at $876,000 deemed proceeds. And here's how my tax return looks. This company is worth, say, $2 million. The shares are worth $2 million. Because I used a Section 85 rollover, I don't have to report $2 million capital gain, $2 million proceeds. My proceeds is $876,000. My adjusted cost base is $10,000. That gives me a capital gain of $866,000 times 1/2 taxable is $433,000. Minus, and this is now to calculate my, that is individual, my taxable income. Capital gain deduction, which I'm labeling here as CGD, $433,000. Taxable income 0. Because I made a Section 85 election, 2 things happened to me. One is I get to say my proceeds are only $876, not $2 million. And this has to be fair market value consideration to respect Section 69. So I took back preferred shares worth $2 million. And as a result of that, I have 876 proceeds, and my adjusted cost base in these shares is 876, and the adjusted cost base of my old OPCO shares that I used to own to the holdco is also 876. If not for the capital gain deduction, if I tried, as I've done successfully here, to increase the adjusted cost base, I'd have to pay a whole whack of capital gains tax that this deduction takes away. So what I've done is I used to have a $10,000 adjusted cost base in here. Now what I've got is an $876,000 cost base in here, and this has an $876,000 cost base here. So that if this company now sells the shares for $2 million, this company's proceeds is $2 million, sells the shares to one of you, and its adjusted cost base is 876. So it has a way lower capital gain than if its adjusted cost base was $10,000 like I had. Sale of OPCO by holdco, proceeds, $2 million, adjusted cost base, not $10,000, $876,000. Capital gain, not $1,990,000. It's more like $1,124,000. We call this a crystallization. what we've done is crystallized the benefit of the capital gain deduction in shares that we still own. And we've done it by using Section 85 and creating a holdco. And as a result, we have a manufactured capital gain, because we're electing not at our adjusted cost base, but at $866,000 plus our adjusted cost base. That's our proceeds, minus our adjusted cost base is sort of a manufactured gain. Fair enough. We're going to claim a deduction against it, which we do. The 433 goes against the taxable capital gain. And in the result, we have what we call stepped up our adjusted cost base from $10,000 to $876,000. Hey, we don't care now if this OpCo gets full of bad assets or whatever, or if the government for some reason repeals 110.6. We just don't care because we have crystallized our capital gain deduction. We've used it even though there's no sale today or maybe not next week or next year. So in the lecture notes, please refer to this article on crystallization written by a lawyer. Pretty good article, actually. Due to the fairly stringent requirements for the lifetime capital gains exemption, an individual may not be able to meet all the requirements on the day. Better to try to use the capital gain deduction now. And as I say, we'll talk about a method of purifying when we talk later about trusts, where we might actually be able to take that $1.9 million of bad cash and get it out of there. Please turn in the textbook to page 370. The capital gain deduction, like other preferences given to capital gains, is a continuing source of contention. The chances of its being removed are therefore high, and this should be considered with all the other factors when investment decisions are being made. Honestly, I think that's overstating the fear. This fear has been there since 1985 when this capital gain deduction was born. So I seriously, I think it's overblown. If I had a coffee with the textbook editor, I'd persuade him to not be as concerned. But it is good planning, and you will get paid for doing a reorganization like this to crystallize the capital gain deduction. And the final thing on this, on the crystallization, is we just showed how it's done with Section 85. It can also be done with Section 86. Client says, I really don't need a holding company, don't want to set one up. Well, you can do a Section 86 reorganization, take back preferred shares, and simply elect at $876,000 in the same way as if you used Section 85 with a holding company. So this works on both Section 85 and 86. Please turn to page 328. As we talked about last time, the capital gain deduction is per person for your lifetime. I got to use it once, only unfortunately for about $80,000. My firm I worked for had a corporation that had sold, and my share of the proceeds was about $80,000. And in that year I had capital losses on other stuff, as I usually do, so it wasn't that great to me, but I can't say that I used it. It was awesome. The point is that every family member has their own access to 866. So if you have, for example, shares owned by parents, children, etc., it's 866 per person. Except we have to mind the TOSI rules. TOSI does not normally apply to capital gains, but when a capital gain is derived from the sale by a minor child of private corporation shares, like our CCPC shares, to a non-arm's length party, and if the dividends would have been subject to TOSI, the capital gain will be treated as dividends subject to TOSI and will not be eligible for the capital gain deduction. It's actually a deduction. This isn't the right word, but it's often called the capital gain exemption. So that's a serious thing that has now blocked the ability for minor children. But as long as the children are of age, for example, university age, we can have the capital gain deduction apply for them as long as TOSI doesn't apply. Please turn in the Income Tax Act to 40 bracket 1.1. Now, as you know, there is an ability to claim a reserve for up to 5 years if, for example, we sell something like the shares of a corporation, and if we don't get all our money, and there's a question on the exam, if you receive some of your money, how much do you have to, how much of the capital gain do you have to include in income? And the answer is a minimum of 20% per year. So if you receive, say, 15%, you have to receive 20%. Pardon me, you have to pay tax on 20% of the gain. But this can work to our favor where, for example, we don't get all our money till, say, the last day of 5 years from now. We're not allowed to avoid paying tax for the whole 5 years, but we're allowed to pay it over 5 years, 2020, 2020. In the case of selling shares to our children, so for example, for succession planning, we're allowed to use a 10-year rule, and that's what 41.1 does for us. So 40 bracket 1 is the one that gives us up to 5 years deferral, 2020, 2020, if we didn't receive any of the proceeds for up to 5 years. And 1.1 gives us the same, except it gives us 10 years. So that's a major planning point for succession planning. And succession planning is a major planning point for corporate tax lawyers as regards businesses and farms and all those types of things. Let's say that we have already used our capital gain deduction, or the company doesn't qualify. So we're going to sell shares and it's going to be real tax on capital gains. Is there anything we can do? So for example, here's a person that owns shares of a corporation. And let's say the person's already used their capital gain deduction. So they're going to have a full up capital gain on this transaction without any 110.6 deduction. So let's say that the shares are worth $2 million. Now I'll change that up. Let's say they're worth $1.5 million share value. And the retained earnings of the company is $400,000. So this is you recall from that balance sheet we did. This is money that the company's earned over time and paid tax on. And maybe some dividends got paid in earlier years, but in the meantime, we still have $400,000 worth of cumulative earnings that haven't been paid out, retained earnings. and the adjusted cost base is $100,000. So that's the adjusted cost base that this person has in these shares. So we're looking at a capital gain of $1.4 million. Proceeds $1.5 million, that's the share value. He's selling the shares to you. And just minus adjusted cost base of $100,000. Capital gain of $1.4 million. Thus a taxable capital gain of $700,000. Good news. This company has some cash in it. Let's say that it's got $400,000, just for sake of this example. What this person does is sets up a holding company and pays a $400,000 dividend to the holding company. Pays a $400,000 dividend to the holding company. And let's say that this target company that's being sold is an operating company, an OpCo, thus doesn't have any RDTOH or any of that stuff, thus no dividend refund, thus no Part 4 tax to pay on this dividend. So Holdco has got $400,000 in there with paying no Part 4 tax, and of course no Part 1 tax because of 112 bracket 1. Well, the movement of $400,000 worth of cash out of here means that the value of this company now is only $1.1 million. Now this company can sell this company for $1.1 million because we've stripped out, is the word, stripped out $400,000 worth of value by way of cash that we've paid upstairs to a holding company. And we don't care if the vendor is the individual, because the vendor doesn't need to get the capital gain deduction. In fact, the vendor can't get it because the vendor already claimed it on some of the transaction. So this holding company will be the vendor. And we'll sell these shares not for $1.5 million, but for $1.1 million. And as a result of the Section 85 election by which this company acquired the shares, this company's adjusted cost base is the same $100,000 that the adjusted cost base was to the individual. Thus, instead of having a $1.4 million capital gain, we have $1.1 million minus $100,000 adjusted cost base is $1 million capital gain. We've done what's called a strip. In fact, it's called a safe income strip. Safe income refers to this amount of retained earnings in here that it is safe to strip out because those earnings have already had tax paid on them. And CRA is quite fine if we take that money and move it tax-free upstairs here, therefore reducing our share proceeds, therefore reducing our capital gain. That is a safe amount to do it with. An unsafe amount would be, for example, if we want to be cute and pay a dividend of $700,000, assuming we had $700,000 cash, let's say. And we're thinking, hey, that's awesome. We've taken the share value of $1.5 million and reduced it by $700,000. Now the share value is only $800,000. Thus, capital gain of only $700,000, $800,000 minus $100,000. Now the Income Tax Act looks at that and says, no, no, no. You moved up here $700,000, that's more than a safe amount. We're going to take that extra $300,000 that you moved out, let's call it the unsafe amount. We're going to tack that onto your capital gain. We're going to tack that onto the capital gain that this holding company has when it sells the shares of this OpCo. Therefore, putting us back in the position if we had just taken out the safe amount, which is $1.1 million proceeds minus $100,000 adjusted cost base equals $1 million capital gain. We thought we could get away with having a $700,000 capital gain only, but no, the excess amount that we paid out, the excess amount of $300,000 being $700 minus our retained earnings, that excess amount is added to, in fact, the capital gain that this holdco has in the opco. And in the textbook, on page 574, is a good example, which now I hope you'll understand better and can go through having seen the example on the board. So under holding companies and corporate divestitures, and here's a company that's got retained earnings of $600,000, and they're going to pay $1 million dividend out with now predictable results. They are going to be left with a larger capital gain than they thought they might have because they've paid out more than a safe dividend. Please turn the Income Tax Act to 55 bracket 1. If you ask five corporate tax advisors what they think the scariest section of the Income Tax Act is, I just about guarantee that all five will say Section 55. And the reason is this: first of all, it goes on for a whole bunch of pages and there's a whole whack of definitions. And Section 55 is what sort of governs this whole safe income thing. And a large part of it actually is unwritten in the Income Tax Act. It's actually been covered by court cases and administrative pronouncements and so on. And there used to be a person in Ottawa who's sort of the safe income, or Section 85 safe income strip person who you would talk to. And the prudent thing to do was to actually get an advance ruling to say, here's the transaction that I propose to do. Will this be okay? Because there just hasn't been as much certainty as there should be about how these things work. A key part of the uncertainty is this. So, okay, I'm paying out this dividend or whatever, and I think it's safe. But maybe I've paid out dividends in the past. Are those dividends safe? Like, was there a sale contemplated, a share sale contemplated at that time? I don't know. Is it possible that someone could connect the dots between the dividend paid today versus the dividend paid 6 months ago or one paid 5 years ago? Because of these words. Thought my glasses were dirty. Because a transaction or event or series of transactions or events referred to in 2.1 and 2. And this is analogous to, you remember in 15 bracket 2 when we were talking about shareholder loans, is it part of a series of loans and repayments? Which is a subjective test that says, does this transaction have a relationship to another transaction we did before? This is the same thing. Thus, this type of reorganization is often fraught with risk. Do we risk doing this strip? Is it possible that another earlier dividend could be included in this, in which case we might have more capital gain than we're planning to do? Now, it doesn't scare us away ultimately from doing the transaction, the safe income strip. It just makes sure that we're cognizant that the facts need to be good and that we need to have good arguments in play in case CRA thinks that, for example, this is part of a series of transactions. The final thing is, the lawyers have to make sure that the accountants are properly measuring safe income. It's a lot more complicated in real life than explained in the textbook, and I have explained. And I once got paid by a client, I think in today's dollars, about $80,000 to figure out the safe income of a corporation. It was a large corporation. It was Standard Aero. I'd like to tell you, and Standard Aero, the joke about Standard Aero is it got sold every 2 years for a period in the 80s and the 90s. And my firm might actually have done that calculation 2 or 3 times. Anyway, long story short, there's a lot to this. It's a very important planning tool, but it's something that requires a lot of care by the lawyers and by the accountants as well. Final discussion today, we'll talk a bit about buying the shares of a corporation and how holding companies can help us. So I'm going to buy the shares of a company, and I need to borrow money at the bank. So I need to borrow $1 million, and I'm going to buy the shares of the company for $1 million. So somebody may have used capital gain deduction or not, I don't care, that's their problem. I'm buying the company, and I borrowed money to do it. So now I have to make principal and interest payments to the bank. So let's say that the loan is repayable over 10 years, $100,000 a year, plus interest. So the interest, I say, fine, I know I can deduct the interest, and yeah, I can deduct the interest. But I'm paying $100,000 a year, ultimately $1 million, and I can't deduct the principal, because there's no deduction for principal. It gets worse than that. In order to be able to repay the principal, I have to take out like $150,000 worth of income out of the company. And assuming my tax rate is say 33%, I'd have to pay $50,000 in tax to be able to have $100,000 of after-tax income that I can use to repay the bank. Not a good scenario. This is the target company, the company that I want to buy. So I'm thinking, okay, maybe a holding company can help the situation. So instead of borrowing the money myself, I set up a holding company, and the holding company borrows $1 million. Now I might have to give a personal guarantee or something like that, but in any case, the debtor is now the holding company, not me. And this is awesome because when the holding company borrows the money, the holding company can repay $100,000 a year out of dividends paid, let's say, by the OpCo, by the target. And this company pays no tax on the dividends. Because let's say the target doesn't have any AII, there's no RDTOH in there, no Part 4 tax. So now at least the $100,000 per year of debt repayment can be done without an individual having to bear tax on some amount like 150 and then pay 100 out of the after-tax amount. Because this company can receive $100,000 from down here without paying any tax on it, just by a tax-free dividend. Tax-free because of 110 bracket 1. Here's the problem. This company is also paying interest on the loan. Not a big problem, but a problem nonetheless. Let's say the interest is 5%. So that's, give or take $50,000 a year worth of interest expense, which is deductible to this company, which is fine. But this company has no income against which to deduct the interest expense. Well, it's got the dividend. Yeah, but it can claim a 112.1 deduction for the dividend, so actually it's got no taxable income. All you're doing is creating losses in this company, and the losses can't be used, they're just carried forward, and they expire in 20 years. And you've got no income in here. What some companies, like this company might do is say, well, we'll pay a fee to this company, which will be income to this company, and that'll soak up the interest expense. Except there's probably really no basis on which to pay this fee, therefore it's not deductible, therefore it's a bad idea. So here's what we do. This company's got the $1 million loan, and it owns the shares of the target company, which it bought for $1 million. And as soon as the purchase closes, these two companies amalgamate. Now what we've got is the business owned by the target company is now owned by the amalgamated corporation. That's the engine of where the cash comes from to repay the bank the principal and also to pay interest. So we're now able to repay the bank the principal out of cash flow coming out of the business, even actually without having to declare a dividend. It's just now cash of the company, the same company that owns the business owes the bank loan. So this is the Amalco, and it has the business, and it has the $1 million loan. Oh, and so the principal gets repaid simply out of after-tax cash of the business. No dividend required. No payment up to me, which is excellent. I don't have to pay tax. Oh, and by the way, the interest is deductible against the same income that's the engine of cash flow to repay the bank. So the benefits are no tax in my hands to repay the bank, an interest deduction, which is down here, and repaying the bank out of after-tax corporate earnings taxed at, say, 9%, versus after-tax Dan earnings taxable at maybe 50%. I might refer to this as an acquisition co. Acquisition co, all one word. So we set up an acquisition co which borrows at the bank and buys the shares, and then immediately after the share purchase, like the same day or the day after, we amalgamate the two. And now the business of the target company and the bank loan are in the same corporation. Your client will take you out for lunch and pay your bill very quickly. Thank you. We'll see you next week.
Yeah, next week we have a guest lecturer, right?